Hi, everyone. Today, my group and I will be presenting our AI and Analytics in Finance final project for our NTU Minimasters course. And our topic today is centered around an analysis on credit risk. So this is a rough breakdown of our presentation. I will be opening with a problem statement, followed by our literature review, and explanation of our data set that we'll be using, the technology that we used, and the modeling results that we obtained, followed by solutions and recommendations. And finally, we'll make conclusions and discuss some future and further studies. So I will begin by stating our problem statement. Essentially, the management of risks define banks. It is incredibly important that banks have the ability and infrastructure in place to be able to foresee and identify the various threats that may come its way to minimize all potential risks. Namely, financial institutions are faced with legal, liquidity, market, operational, and credit risk, all which can lead to severe financial and reputational repercussions. So while all probable risks should be appropriately analyzed by banks, arguably the biggest and most important risk to a bank is credit risk. So according to the Monetary Authority of Singapore, credit risk can be defined as the risk arising from the uncertainty of an obliger's ability to perform its contractual obligations, whereby the obliger is someone who is under a contract and has a certain requirements to fulfill. So due to the nature of financial institutions, it is not really possible for a bank to have zero credit risk, but rather it is more valuable to them to know how to appropriately manage the risks. So for the purpose of this report, we will be using data analytics techniques to analyze the risk of personal credit default. And in the context of our consumer credit data set, there are a lot of metrics that can be tracked to predict the credit behavior of such creditors. And therefore, the aim of our report and this presentation is to examine the various factors that may influence creditor behavior and how banks can then use this to analyze and predict their overall credit risk profile. More importantly, through having a sufficient predictive analysis, banks can continue to have a better grasp on their risk management and reduce the frequency of default credit risk. So now I'll pass on the time to Brandon, who will go through our literature review.
Following on from our problem statement, I will cover the literature review on credit risk and its consequences. Banks today face numerous sources of risk, namely credit, operational, market, and liquidity risk. This report focuses on personal credit risk. Credit risk is the risk an entity holds as a probability of loss, resulting from a counterparty's failure to repay a loan. Credit risk for banks involves credit default risk, concentration risk, and country risk. Credit risk management has been increasingly important in banks worldwide to properly insure themselves against unexpected losses in times of downturn. Considering banks are unable to predict which party will default on payments, proper credit risk modeling techniques are crucial for them to competently assess and manage counterparty and credit risk in order for them to alleviate the severity of losses. As a private wealth management firm and retail bank in Switzerland, managing credit risk is one of the most important priorities for UBS. As mentioned in its 2019 annual report, the scale of UBS's business activities is dependent on the amount of capital available to mitigate the risks in their core businesses. Major sources of credit risk arise in both the global wealth management as well as personal and corporate banking businesses. As a whole, UBS emphasizes the importance of their risk governance framework and highlights the key roles in their three-tiered defense against various sources of risk. One of the most pertinent examples of inefficient credit risk management stems from the 2008 financial crisis. While exact causes of the housing bubble precipitating the financial crisis are disputed, one of the most paramount reasons that led to the severity and extensiveness of the crisis tends to be banks' careless management of individuals' credit risk in mortgage loan applications. Due to these lax risk management measures, mortgage loans were granted to home buyers that were previously considered uncreditworthy, creating a glut of homeowners that were eventually unable to pay off their loans. As a result, delinquency and default rates skyrocketed, leading to a rapid devaluation of mortgage-backed securities based off these bad loans that set off a domino effect of defaults in the financial systems across the world. It eventually took the global financial system years to recover from this collapse. As a direct result of this, the Basel III capital and liquidity standards were also adopted by countries around the world to ensure such a crisis never happens again. In the rest of this report, we will mainly be focusing on personal credit default risk.
Let's now take a look at our data set, which should be used to train our model. So first of all, we have the data description. So from our data set, we have a total of 32,851 records with a total of 12 variables. So on the right, you can see that it is a table of the list of variables and also a description of each individual variable. So from our data set, you can see that we have variables such as the person age, their annual income, their home ownership, their employment length, their loan intent, whether they are taking this loan for medical purpose, education purpose, or for personal reasons, the loan grade, loan amount, etc. And from these 12 variables, our target variable will be the loan status, because what we want to do is that we want to predict what will be the likelihood that the borrower will default on their payment. So for loan status, 0 represents that they did not default on their payments, and 1 representing that the borrower defaulted on their payment. And in order to predict our target variable, we have made use of 3 independent variables, which are the person age, the person income, and also the loan amount. And the reason why we chose these 3 independent variables is because we feel that these 3 variables will highly likely predict our target variable, which is the loan status, because we feel that if a person is very young and earns a low annual income while taking a high loan amount, and this borrower will most likely default on their payment. Next, before we do our analysis, we need to make sure that we have a complete and accurate set of data. So we will be cleaning up the data, and we'll be using the df.dropNA command. So what this command does is that it will remove those records that have incomplete data. So for example, we have 12 variables. So those records that are missing 1 or 2 of the variables will be removed from the data set for analysis. And after which we'll be using the printdf command. And we can see that after dropping off these records, around 4,213 of them were being removed, leaving us with around 28,638 records for our analysis. Next, it will be the statistical analysis. So by using the df.describe command, it will provide us with a summary of the statistical analysis. So as you can tell from the slide here, for the 12 different variables, it will provide us the mean of each variable, the standard deviation, the minimum, maximum, and also what is the 25%, 50%, and 75% quartile. And lastly, it will be the data visualization. So data visualization, it will help us to understand our data in a faster way. So what we mean by that is that if you look at the graph on the left, this graph shows the amount of people that defaulted on their payments from our data set of 28,000, around 20,000 records. So from one look, we can straight away tell that majority of the borrowers, they did not default on their payment, and only a minority of them did, around 6,000 to 7,000 of the borrowers, they defaulted on their payments. And on the right, you can see that it is a heat map of the variables. And so this heat map, it shows us the correlationship between our independent variables and also our target variables. So the darker color it represents that the variables are more correlated, meaning to say that this independent variable will more likely predict the target variable, which is the loan status. And from there, we can tell that whether the borrower, they will indeed default on their payments or not.
For this exercise, we'll be mainly using the 5 models that have been shown in class. For the training and testing split, we will go with the recommended amount of 0.3, which is 30% for the training set and 70% for the testing set. We started off with 30,000 of data points in the original Excel, and after cleaning up the Excel, dropping the NA and normalization, we are left with 28,638 data points, and of which 30%, which is amount close to 8,600, will be used for the training set, and then the testing set will be the remaining amount. The reason that we are splitting it as such is so that there can be cross-validation across the sets. So the first model, neural network, is a slightly more advanced model that tries to replicate how the human brain thinks. It learns by going through repetitive procedures to improve its accuracy. So as you can see, we have an input layer, and what we inserted is a hidden layer which learns according to the training set, how it should evolve and react, and then result in the output. It's a more advanced model that are more typically used for example, in today's world, you have the Google or Siri speech recognition, which comes in many variation. So from a quick glance at, we don't think that it will be extremely viable, given that our data set is pretty straightforward and simple, and the variables we have identified are only 3 dependent variables. Secondly is the linear model. So in linear regression, we have a few models. First one being the logistic regression, and then secondly being the rich tree classifier. So it's one of the most commonly used model for machine learning purposes due to its ease to interpret and the accuracy of prediction, as long as the data is not perfectly correlated. And the outcome is typically binary in nature, which suits the purpose of this study. So in this study, we'll try both logistic regression and rich classifier, and both of which should have similar outcome, as our outcome is binary in nature. Thirdly is the decision tree. Classification and regression trees, also known as CART, is a type of supervised machine learning model that can be used to predict the value or a class of target variable by learning simple decision rules from the training data set. The one key limitation of using the decision tree model is that it might be prone to overfitting, especially if we don't give it enough training value. For our case, if you use a percentage of 30%, it should be quite fine. Next, we will use a random forest. So random forest, as you can see from the picture, is pretty much like advanced and more complex decision tree, whereby you split it into multiple decision tree, and ultimately you aggregate the results and use an average of what we call a majority voting. So we utilize ensemble learning, which combines many classifiers to provide solutions to complex problems. Given that our data set consists of simply 3 independent variables, the random forest methodology might not be the best model to implement. Lastly, we are using the XGBoost. It's an implementation of gradient boosted decision tree. So once again, it's based off the original decision tree, and we boost certain input on the branches, and its limitation include requiring good knowledge on adjusting the parameters to make sure that the boosting can lead to accurate result. Otherwise, if you are not very familiar with the inputs and the parameters to adjust the boost, ultimately it could lead to inaccurate results. Over here, you can see from our result sets, most of which have a pretty reasonable and high accuracy. So as a rule of thumb, anything above 70 should be quite reasonably accurate, and we have achieved for all test result a result of 0.78 minimally. We can see decision tree. The decision tree model gave us the highest accuracy in both the train set and the test set. And this is kind of expected, given that the simplicity of our data set. A simple model like a decision tree should be able to map it accurately. Thanks.
So let me elaborate more about the solutions and recommendations for the data set. So we did a feature importance from the variables, and then we are able to see that the person's income is the most important factor when predicting the loan default. So having this in consideration, we propose the following recommendations. So increasing the minimum threshold for personal income can be considered as a step to reduce the likelihood of defaults. As firstly, this variable is the most important factor, as well as having a higher income will reduce the likelihood of loan defaults according to the correlation heat map. And then also introducing stricter qualifying criteria for loan disbursement. So what this means is that we see that the higher the person's age, the less likely they are to default. Hence, if it's possible to introduce stricter qualifying criteria surrounding the age of a person, that will obviously reduce the likelihood of defaults in the future. And also offering more lower interest rate loans can be another way for the bank to reduce likelihood of default, as higher interest rates are positively correlated to loan default, which means that higher interest rates has a higher tendency for people to default their loans. So next will be about the conclusion and future studies. So we calculated the initial default rate based on the data set that they had that was provided to us, and it was shown that the initial default rate is 21.7%. And with our model, we are able to reduce the default rate to actually be 14.7%, as our model has an accuracy of 85.3%. So with this improvement, we are able to show that both parties will be more protected from the risk associated with the loans, both from the lender and also the customer. So we propose the following future studies. So studying the breakdown of the industries that the individuals are working in can be one. So by having these details, it can possibly add interesting insights between the various industries and also the variables measured in the original data set. So this can help banks or lenders to actually segment their current customers and also future ones, and introduce policies or measures to reduce loan defaults and identify those who might be risky. And also this will give them a better understanding of the customers, and being able to push out curated products that suit each of the segment to minimize default. And it is also important to study all possible angles, as more data points and variables can measured can uncover insights that can make for better predictions and conclude findings. So with that in mind, thank you so much for listening to the presentation. Thank you.